Hey everyone, welcome back. Today's title might sound a bit harsh, but stick with me, because we're diving into something that's destroyed more trading accounts than almost anything else: revenge trading. By the end of this video, you'll not only understand why revenge trading is so dangerous, but also have practical tools to catch yourself before you fall into this common trap. So what exactly is revenge trading? Most people think it's just trying to quickly win back money after a loss. But it's much deeper than that. It's a perfect storm where your emotions hijack your decision-making process. It happens when you've taken a loss that feels unfair or painful, and instead of accepting it, you immediately jump back in with larger positions or riskier trades, determined to get even with the market. It's like trying to argue with gravity, and the market always wins these arguments. Let me share a quick story that might sound familiar. A few years ago, I was having a great trading month, up about 15%, following my system perfectly. Then came that one trade, a setup that looked textbook perfect. I entered with my usual position size, confident in my edge. But minutes later, unexpected news hit and the market gapped against me, blowing past my stop loss. Boom, a 5% account loss in one trade. Now, here's where things went south. Instead of stepping away, I immediately jumped back in, convinced the move was overextended. The market took my money unfairly, I thought, and I'm going to take it right back. I doubled my usual position size, ignored my indicators, and entered again. You can guess what happened next. The market continued moving against me, and my 5% loss quickly became 12%. This is the revenge trading death spiral, and it follows a predictable pattern. First comes the triggering loss, often one that feels especially unfair or that hits your financial or psychological weak spots. Then comes the emotional reaction, a toxic mix of anger, embarrassment, and determination to prove yourself right. This pushes you into impulsive action, trading outside your plan, increasing position sizes, chasing entries, moving stop losses, or holding losing trades too long. And finally, the devastating result: account damage far worse than the initial loss. Why is this pattern so common and so destructive? It comes down to basic human psychology. Our brains evolved to maintain status in social groups, and losing feels like a status threat. Research shows the pain of losing is psychologically about twice as powerful as the pleasure of winning an equivalent amount. When we lose in trading, especially in a way that feels unfair, our brain treats it like a social rejection, triggering the same brain regions as physical pain. But here's the crucial insight: understanding that revenge trading is natural doesn't mean it's acceptable. It just gives us the power to recognize and interrupt the pattern before it destroys our accounts. Let me share 3 practical techniques that have saved my account, and those of many traders I've mentored. First, the cooling period rule. After any loss that exceeds your daily risk limit or feels emotionally charged, commit to a mandatory break from trading, at least 2 hours, preferably the rest of the day. This isn't just feel-good advice. Studies of professional traders show their decision quality drops significantly following losses, but returns to normal after a cooling period. During this time, physically step away from your trading station. The market will still be there tomorrow. Second, implement the second opinion protocol. Before placing any trade after a significant loss, write down your specific reasoning and check it against your trading plan. Better yet, if possible, run it by a trusted trading friend or mentor. When we're in a revenge mindset, we're masters at rationalizing poor decisions. An outside perspective cuts through this self-deception. Third, use the scale-down technique. If you've taken a larger than expected loss, your next 3 to 5 trades should be at reduced size. I recommend 50% of your normal position. This accomplishes 2 things. It limits potential damage during your psychologically vulnerable period, and it creates a gentle path back to normal trading. The goal isn't to avoid trading entirely, but to rebuild confidence through small wins. Let's bring this all together with a better way to handle the scenario I described earlier. After taking that unexpected 5% loss, I should have acknowledged the emotional impact. I'm feeling angry and determined to get even, Classic revenge mindset. Initiated my cooling period, stepped away for the day, and returned the next day with half-size positions until I regained my emotional equilibrium. Remember, the market doesn't know you exist, and it certainly doesn't care about being fair. It simply presents opportunities, some of which will work in your favor and others that won't. The professional approach isn't trying to get back at the market, it's preserving your capital through the inevitable rough patches so you can capitalize on future opportunities. Let me leave you with this thought. The difference between failed traders and successful ones often isn't their strategy, or even their win rate, it's how they respond to losses. Revenge trading transforms manageable losses into account killers. Break this cycle, and you've eliminated one of the biggest obstacles to trading success. What about you? Have you experienced revenge trading, and what techniques have you developed to combat it? Drop a comment below. I'd love to hear your experiences. And if this video helped you recognize a pattern in your own trading, hit that subscribe button for more psychological insights that could save your trading account. Let's grow together as smarter, more disciplined traders.